This buyer paid $2,200 at closing, and it's going to save him over $20,000 in the life of the loan. It's not a promo, and it's not a sales pitch. It's just math. He paid for something called discount points. It's one of the easiest ways to save money on a mortgage. And most people overlook it thinking it's some sort of additional fee. I'm Ricardo Carrillo with RC Lending Advisors. My team and I cover all 50 states, and every single week I break down a real deal that my team and I have closed. The numbers, the strategy, and why we made the decision that we made. Let's jump right into this one. My client bought a primary residence home in San Leandro, California, which is right next to Oakland in the East Bay. The purchase price was $638,000. He put together a $606,000 loan with a 30-year fixed regular loan without doing anything special. His interest rate would have been around 6.1, 6.25, and so he chose to pay a little bit extra at closing to bring his rate down to a flat 6%. Before I get into the math though, let me explain what a discount point is, because most people don't know and there's a lot of confusion around it. Discount points are essentially prepaid interest. That's it. You're paying the bank money upfront today in exchange for a lower interest rate over the entire 30 years of the loan. Now, one full point costs 1% of the loan amount. So if you had a $606,000 loan, 1 point or 1% is $6,060. Now, my client didn't pay a full point. He actually paid less than half of one. It was about 0.3 points. So that cost him around $2,200. And in exchange, his rate came down from 6.1 to 6.0. So his new monthly payment was $3,600. Now, here's where this gets good though, because whenever you pay for points to lower the interest rate, the question always should be, how long do I need to stay in this loan before the money that I saved equals the money that I paid upfront? It's a break even. My clients paid $2,200. That saves him about $48 a month. $2,200 divided by 48 is 46 months. So he has to hold this loan for just under 4 years, 3 years and 10 months to be exact. So if he stays in this loan longer than that time frame, which most people end up doing, and most people don't refinance or sell that fast, he's actually making money on this decision because every year after that, it's pure savings. So over the full 30 years, his $2,200 upfront saves him more than $20,000 in interest. It's basically a 10-to-1 return on your money if you're thinking about it that way. Now, I want to clear something up though, because there's two different things in the mortgage world, and they both get called buy downs, but they're totally different, right? What my client did is actually something called a permanent rate buy down. Paid the cash upfront, the rate stays lower for the entire 30 years. Every month, there's a lower payment for the entire 30 years. Now, there's another product, though, that banks released a couple years ago during COVID called a temporary buy down. And you've probably heard of it. It's called a 2-1 buy down. That's where the rate is lower for the first 2 years, and then years 3 through 30 goes back to normal. Now, sellers or builders, who are the ones that typically offer this, are the ones that pay for it as a part of the deal. It's a completely different thing, has kind of similar name, but it's different math. Temporary buy downs make sense if you think the rates are going to drop soon and if you'll refinance before the full interest rate kicks in. Permanent rate buy downs, on the other hand, make sense if you plan to stay in the property longer and long term, and the math makes sense, right? This way, we know which one is right for you, and sometimes people actually do both. But at the end of the day, it's all break even and it's all math. So we want to run the numbers. How much is it going to cost? How much are you going to save? And how long until those savings beat the cost? Paying points, though, makes sense when 3 things are true. The first one is that you plan to stay in the house for a very long time. If you're going to be there for 5+ years and your break even is under that time frame, then the math makes sense. 2, if you have the cash and you want to pay the points, sure, do it, right? You might be cash tight at closing. You're going to spend a little bit more money, but at the end of the day, you're going to have a higher interest rate. You're going to save more money in your pocket. You can do whatever you want to the property. And then the last one is that the rate drop's actually meaningful, right? Because paying a lot of money to drop the interest rate by a tiny little bit amount doesn't make sense. Paying a little bit of money for a big rate decrease really does make sense though. Now in this situation, for this client, all 3 boxes were checked. It was a small upfront cost. It was a real rate drop, and he planned to stay there long term. So we ran the numbers and we said, does that make sense? Do you plan to stay there? Yes. Okay, great. Then let's make that decision. Now I'll give you the other side too, because sometimes paying points doesn't make sense. If you think that interest rates are going to drop soon, like in these next 2-3 years, and you refinance in that time frame, any points that you paid right now is really just money that's going to the garbage. You don't get it back when you refinance, and you're already tied at cash to close for closing. So why spend more money? Every dollar that you spend on points is a dollar that you're not putting towards an emergency fund. And if you're planning to sell your house before you even hit the break even, then of course it doesn't make sense to pay points. If you're going to be there for 3 years and the break even's only 4, well, you're losing money. So that doesn't make sense. And the only way to know is to really run the numbers on a specific deal, which is why my team and I do this with all of our clients on every single deal. Now, here's the full picture. The purchase price was $638,000. We had a $606,000 loan amount. It was a 30-year fixed loan. The rate was at 6%. Monthly payment was $3,600. The money that was actually paid in points to lower that interest rate was $2,200. That left us with a $50 a month savings and a 46-month break even. Total savings over the 30 years is over $20,000. This is a textbook example of when paying points pays off. And if you're buying soon and your lender hasn't talked to you about this or even understands what a break even is, talk to them. And if you want to run the numbers the right way, my team and I are always here. You can head to rclending.co to find out how to reach my team and I. You can also follow me on Instagram at Richie the Lender for deals just like this one that I break down every single week. And if you haven't seen my other Deal of the Week videos, you can check those out either here or here. Make sure that you like and subscribe to the video. I will see you guys in the next Deal of the Week.